So let's talk about the banking sector, and it's quite amazing how these folks managed to survive 2016, the year we call the year of recession. So let's get Usman Abdulkadir, who is the Chief Finance and Risk Officer at SunTrust, to talk to us this morning. And overnight we got these numbers. Wema Bank, for example, reported 18% jump in gross earnings, interest income, non-interest income, all moving in the north. And SunTrust also reported 160%. For SunTrust, this is the first earnings since the bank became a commercial lender just about a year ago. Usman, thank you very, very much for coming. Good morning.
Thank you very much.
Yes, so to answer the question, how did you bankers manage to beat the 2016 recession?
If you look at the year 2016, it was actually a very challenging year for everybody, not only the banks, but also for the corporate sector. Basically, we see how the scarcity of FX in the market, has affected materially corporate performances. Most of the manufacturing companies in particular are dependent on the importation of raw materials, and that scarcity has led to a spike in their input costs. But for banks, I would say the earnings we have seen mainly a result of revaluation gains from the net position they have on their FX balance sheets.
So if everybody's, some folks on the street says banks never lose money.
Actually, banks do lose money.
Either way, you guys always have a way of making money. Well, everybody's scratching with the FX. You folks were reevaluating loans and what have you. But again, there are still risks despite some of these numbers we're looking at. What you call constant and emerging risks. So from 2015-2016 period, and where we are, what do you see as the constant and emerging risks in your sector? You are a risk analyst, so I'm sure you are the right person to ask that question.
Basically, the Nigerian banking sector operates under a very difficult dynamics. It's a high-cost economy. Banks are no different from other segments of the economy generally. So high input costs, especially the high operating leverage they are operating under, has made it difficult for them to operate with small margins. So anytime the economy falters, you tend to see rapid increase in non-performing loans and rapid increase in costs, basically. So these are the challenging times. The risks I see there are mainly two. We are lenders, as everybody understands, and if the economy is not doing well, our borrowers are not able to pay back their loans. So credit risks are extremely important within the context of banks' balance sheets in Nigeria. Then operational risks are also high, especially due to that high operating leverage that we see in the sector. Okay, so basically these are the two things that banks have to put their eyes on. And if you disaggregate operational risk and you see how changes in innovation, changes in technology are introducing competition into the sector, then even the small incomes that banks are making tend to dissipate into insignificance, because there are corporates, or there are, I would say, players that are non-traditional banks, but they are also introducing dynamics into the sector by creating additional competition in some of the things that
insurance, telecoms, and all
insurance,
that.
telecoms, pension funds, and small IT companies.
Even
the telecoms are excellent now.
They're snitching your lunch.
Absolutely.
They're taking some lunch from you.
Absolutely.
This is very interesting. But if you look at last year, over the last 2 years, non-performing loans was one very naughty and nasty problem for that sector. How are you folks dealing with this as we step into the new year?
As a commercial lender, if you are opening shop in an economy that is weak, that has weak macroeconomic fundamentals, as we have seen in 2016, you have two things to do. One, you have to be very cautious. Secondly, you have to be very cautious again. And that was what we did.
And perhaps be cautious again.
Absolutely. So what we have done is, firstly, to restructure our balance sheets, to move away from where we had to spend money. I mean, we, as a mortgage bank, our assets and liabilities are fairly evenly matched, but the funding side, tends to be very high. Banks dealing with mortgage loans have had to borrow money from commercial banks at commercial rates to underwrite loans that have a fixed rate.
And you did that while you were a mortgage bank.
While we were a mortgage bank.
So the transition
is
very interesting.
Absolutely. So the first thing we did is to restructure our balance sheet and move away from those high cost funding sources. That has materially reduced our interest costs. And the second thing we did is to really move right into the heart of our customer target market and grow our deposits. Our deposits has grown from a few hundreds, about 700 million, to 4.2 billion within the 4 or 5 months we operated as a commercial bank. So that has helped to reduce our over-reliance on those high costs. And then, of course, as I said, we had to be cautious, so we had to really scale down on the creation of additional loans.
Okay, that's a very interesting story. I'm sure we have quite a lot, but well, congratulations, at least scaling the first year.
Thank you very much
of being on the street and joining the rest of your colleague, and you joined doing what the period of recession. Perhaps you will be remembered by that in history as the bank that came out during recession. Very difficult time to come back. Usman Abdul Kadir, who is the Chief Finance and Risk Officer at SunTrust Bank.